So what are mutual fund fees and how do they affect us? In this video, I'm going to go over mutual fund fees and just general fees associated with paying someone else to manage your money and the damage that has on your returns and portfolio gains over your lifetime. Hey, how's it going? This channel is all about trading the stock market while allowing you to maintain a full-time job or trade as a full-time job. So if you're new here, consider subscribing. And today we're going over management fees. Anytime you invest in a mutual fund or just have someone managing your money for you, it's going to cost money because they're providing you a service. And that comes out in fees, usually called expense ratios on mutual funds. These expense ratios can vary based on the fund, depending if you're in a mutual fund, an index fund, or either having a personal finance manager manage your money for you, or even if you're investing in a hedge fund. But generally, for mutual funds, you will have either passively or managed funds. And passively managed funds means the fund manager really doesn't do that much with the fund. They will buy something and hold it for the long term, meaning they really don't have to put that much work into it, and so the expenses will cost less, and that's why you will have a lower expense ratio. With more actively managed funds, they have a higher expense ratio and fees associated with those. So a mutual fund, an actively managed mutual fund, can have pretty low expense ratio compared to something like a hedge fund where they are managing it hour by hour. The major setback though about investing in a fund managed by someone else is they all have fees. The fees can sometimes offset your gains by a large margin. Even though you may be getting a good return on your money, you could be doing just as good by yourself. But to dive in on how these fees work is the fees are always calculated on your total account assets for that year. So if you have an expense ratio of 1%, they don't take 1% of your profits, they take 1% of your account. So if you have a $10,000 account, they will take $100 away from your account at the end of the year when they take those fees out. This may not seem like that much money. If you're making 10% return a year on your $10,000, so if you're making $1,000 a year, losing that $100 to make that doesn't seem like that much, especially when all you did with your money was just put it in a fund and just leave it for the year. That seems pretty sweet. But the idea is you're losing that money over and over and over every year. And if you're investing for the long term, like 40 or 50 years, that can really add up. And because that money isn't in your account every year, it's not getting compounded on over your lifetime. So to show you what I'm talking about, here is a theoretical $10,000 account over 50 years with 10% return on it. And I think with life expectancy increasing pretty rapidly, it's smart to plan for living a long life. And that's when these fees show their damage to your growth more and more the longer you have them. So with this, there are 5 different accounts with different fees associated with them, and you can see that initially 0 versus 1% fee over that time is a huge amount. It's almost pushing double the growth, which is kind of mind-boggling. Most passive funds like index funds or passively managed mutual funds, those will be under that 0.5% expense ratio per year. More passively managed funds or passively managed portfolios will be over that 0.5%. So more actively managed mutual funds or actively managed portfolios or just personal finance managers or then even hedge funds, those will definitely be over 1%. Personal finance managers and hedge funds will generally be 1 or 2% expense ratio, and then hedge funds will even take 20% of their profits as well. So their expenses will be a lot more. And one thing I do want to point out is, even though these are a lot easier way to invest, these people don't care about your money. All they care about is giving you a good enough return to keep you around and keep you in their pocket, so then they can make that huge paycheck from that expense ratio. You are the one that cares about your money the most, and no one will care about it more than you. So I think that's why it is extremely important to, if you have the time or the interest at all, to look into managing your own money, even on a really light level. You don't have to be day trading or doing all these complicated things all the time. You can just buy a stock and hold it for a year, a couple years, and you can still get good returns or keep up with the market without having to pay these kind of fees. Comparing fees just to pick a fund isn't always the best way to do that either though. You can have a fund with high fees but also high return. But I do want to stress that past performance definitely isn't an indicator that that fund will do good in the future, but those fees will always be there eating away at your money. So it generally is better to, if you want to go the more passively or fund management kind of investing, try and get one with the lowest fees possible and really never go over 1%. There's a ton of passive index funds or mutual funds now, and their expense ratios are really low. They are getting a lot better, even less than 0.1%. So the gap is closing, but in the long run, it still begins to add up for a lot of money. And you may even be able to do better than the stock market, learning about the stock market yourself and being able to invest and buy stocks yourself. Hey, thanks for watching this video. If you want to learn more about actively managing and learning how to manage your own money, make sure to subscribe to the channel. I'll be diving a lot more into that in the future. And if you have any questions right now, make sure to ask them in the comments below. Hit that like button, and I hope to see you in the next video.